Welcome back to the Deep Dive. Today we're taking that stack of research you sent us, and we're really digging into a quiet behavioral shift.
It's a fascinating one.
Our mission today is to figure out what owning a share actually means now in the 21st century. We're calling this deep dive the erosion of ownership.
And it's such a crucial topic because we're exploring this deep contradiction. The language we all use, ownership, confidence, long-term value, it's the same language from 100 years ago.
Right.
But the actual behavior tied to those words has, as the sources suggest, changed rather a lot.
I mean, if you ask anyone, with a pension fund what buying a share means, you'll get the same perfectly logical answer. You're backing a business. You put money in, you wait a few years, and you share in the rewards.
And that description, it's not wrong. It's just, as our sources point out, fundamentally incomplete for describing modern finance.
And that's the contradiction we want to unpack for you. This is less a history lesson and more a, hang on, when did that happen kind of conversation.
Exactly. It wasn't one big event. It was this evolution, a series of, legal tweaks, new structures, and then technology that each nudged behavior just a little bit.
Okay, so let's start at the beginning. The original DNA of a share. Back when patience wasn't just a good idea, it was structurally unavoidable.
Right. And the original problem shares solved was, as the source material calls it, a fairly boring one.
Which was?
Scale and risk. I mean, think about it. Building a global shipping fleet or laying thousands of miles of railroad, these things were just too big, too expensive, too risky for one person to fund.
So the solution was to pool the capital. And the people who put the money in, they became the first shareholders.
Exactly. And they got a small claim on whatever profits might show up down the line.
Yeah.
But that original model had these huge unspoken assumptions built right in.
Okay.
First, the money went in up front to build a real thing, a factory, a railroad. Second, everyone expected to wait, maybe for a generation. Third, your return depended entirely on the business actually working.
And the fourth one. This seems to be the linchpin. Patience was, as you said, unavoidable.
Completely unavoidable. The ability to get out the liquidity was tiny. Costs were high. You couldn't just tap an app and sell. If you owned a share, you were probably sticking around.
So it's not that the original investor was, a better, more noble person. It's just that their options were limited. They were basically locked in.
That's the key insight from the sources. The system itself forced you to be involved. It tethered you to the outcome because getting out quickly just wasn't an option yet.
Okay, so if that structure enforced patience, what was the first thing that started to chip away at it? The sources point to limited liability.
Yes. This is the origin point of detachment. It shows up in the mid-19th century in the UK. The Limited Liability Act of 1855.
And the goal was a good one, right? To get more people to invest.
A very noble goal. Before that, if a business you invested in failed, you could lose everything. Your house, your savings, all of it. People were, understandably, very wary.
So limited liability just says you can only lose what you put in.
That's it. And that's where we get the LTD you see on company names in the UK or the GmbH in Germany. It caps the loss. And of course, that's a huge positive for the economy.
More people invest, more projects get funded.
Right. But there's a quiet behavioral nudge there. Once you cap the downside and the markets are becoming more liquid, there's just less reason to stay attached to a failing company.
You can just cut your losses and move on.
Before, the risk of total ruin kept you fiercely involved. Now, you can sell, limit your loss, and find the next thing.
So ownership starts to shift from being a commitment, a relationship, almost to something colder, just temporary exposure.
That's the perfect way to put it. It's a small legal tweak, but it gives the investor permission to let go.
And then, as markets just get bigger, the distance between the owner and the actual business grows, doesn't it?
Yeah.
The original shareholder might have known the guy running the local mill.
Absolutely. Later on, shareholders just vaguely knew the stock price, maybe the industry. And as ownership fragmented into thousands of people, owning a share stopped implying a lot of things.
Like what, specifically?
Well, it no longer meant you knew the product, or that you cared much about the workforce, or that you had any real view on where the company would be in 10 years. That became management's job.
So instead, owning a share just means having a position. And I think that word position is a really crucial shift.
It is, because a position is transactional by nature. You open it, you close it. Even if you hold it for years, the fact that you could close it at any second changes the dynamic completely.
Okay, so then the next layer is where all this money is coming from. Shares become the domain of pension funds. And this is often framed as a great success story.
And in many ways, it is. It's wealth creation for ordinary people.
Right.
But it adds all these layers. Your retirement money doesn't go straight from you to a company. It goes on this very complex journey.
Let's trace that chain because the pressure points are in the details.
Okay, so you, the saver, put money into a pension scheme. That scheme gives it to an asset manager, a huge investment firm. That manager is then judged obsessively against a benchmark like the S&P 500, and consultants are watching everyone. It's a very rational but very complex structure.
So when we read a headline that says, shareholders demand better returns, it's not really talking about the person hoping to retire in 20 years.
Almost never. It means that complex chain of intermediaries where each one is responding to their own short-term pressures. The asset manager has to beat the benchmark this quarter.
If they don't, they risk losing the contract.
Exactly. So the money might be for a retirement 30 years away, but the career of the person managing it depends on the next 30 days of performance.
That's the incentive mismatch right there.
It creates this powerful structural bias towards short-term thinking. Even if they want to be long-term, the system nudges them not to be.
So that brings us to the final accelerators, the things that took all this and just hammered it home.
The first one is the ability to profit from failure, short selling. Once you can make money when a company's price falls, the entire idea of belief in the business can just vanish. You don't have to be confident in their 10-year plan.
Your goal shifts.
Yeah.
It's not about finding good businesses anymore.
It's about making correct predictions. And a good business and a correct short-term prediction are often two very, very different things.
And then the final piece of the puzzle is just pure speed, technology.
Technology comes in and just removes the last bits of friction. Trading happens in microseconds. Humans are too slow, so decisions get automated.
And at that point, holding something for years, which used to be a sign of confidence.
It becomes a sign of inefficiency. Why would you let capital sit there statically when you could be optimizing it thousands of times a second? Patience becomes a liability.
So we end up in this very strange place. We're using the language of commitment, but practicing the behavior of detachment.
That's the synthesis. We still talk about ownership and confidence, but the behavior of most of the capital in the system is driven by short-term signals, by speed, by positioning.
And it's crucial to understand that legally, not that much has changed since, the 19th century.
Structurally, no, but behaviorally, almost everything. We took a system designed for patient, sticky capital, and we layered on safety, then liquidity, then intermediaries, and then lightning speed.
And then we started judging everyone in that system on short-term results.
Right.
And that's really the final takeaway, isn't it? When you see that evolution, all the layers, modern financial behavior, stops looking shocking or irrational.
It stops looking like greed and starts looking predictable. Everyone is just responding rationally to the incentives of the system they're operating in.
A really profound way to reframe it. Thank you for joining us for this deep dive into the source material today.
And here's a final thought for you to take away. Building on all this, if ownership for the majority of capital is now really just temporary exposure, how robust are the traditional legal rights that come with it, like the right to vote on company strategy? That's a serious question for corporate governance when the primary incentive is just correct, short-term positioning.
Something critical for you to mull over. We'll see you on the next deep dive.